Welcome to Investment 360. In the hot seat this evening, Henk Potts, Director of Global Research and Investments at Barclays Wealth in London. Henk, always appreciate your time. In terms of your investment strategy from where you're sitting right now, perhaps you can just take us through the highlights.
Well, I think as always we continue to promote the idea of a balanced portfolio, perhaps now more than ever given the volatility that we've been seeing during the course of 2011 and into 2012. That's an important concept. So the way we've been positioning portfolios with clients is to have the necessary insurance in place to deal with the potential risks that are likely to occur during the course of this year, while still maintaining exposure to the upside if we were to get a positive surprise. So in terms of the breakdown in the simplest form, we still remain overweight in cash. We believe that's the best safe haven out there at the moment. At least it can't fall in nominal terms. We think it's better than gold, better than the Swiss franc, certainly better value than treasuries at the moment. Our main overweight continues
Henk,
to be
I want to pause on the cash position
equities.
and throw it to David at this point.
You know, when you say you're overweight in cash, what does that mean in percentage terms? You know, in a normal portfolio or a client's portfolio, when you say overweight cash, because I assume that cash is giving you absolutely no return at all. So how much of a percentage would you put in?
We've got around about 7% in terms of the overweight for cash, so significant position compared to where we'd normally be compared to our strategic asset allocation. But as I say, in terms of where we see the ability to insure against risk, we believe that's the best possible position to have for clients. Because quite frankly, your other opportunity is, of course, develop government bonds. And we see those as being incredibly expensive at the moment. And also appreciate that actually there's an awful lot of issuance out there. Volume is very high. And eventually, I think some of the traditional headwinds for government bonds will come back into play.
Henk,
higher interest rates, they may be some way down the route.
I want to come back to your cash exposure and that 7%. What currency are you holding that cash in?
Well, it really depends for which clients in which geographical region. So we're, of course, putting together bespoke portfolios for individual clients, and that really depends what their liabilities. So in many cases, we're matching that against their liabilities or where they're domiciled. So that really drives that decision to a certain extent, because actually when you look across the currency complex, it's very hard to choose from the major currencies at the moment. We don't see perhaps significant movements being generated from the dollar, from the euro, or from sterling. They've all got their own individual problems, slightly to hold them around the current levels that we see at the moment. Perhaps the areas that we'd be most cautious on would be the Japanese yen or the Swiss franc, for example, that we believe looks overvalued at these types of levels.
Henk,
so that's probably an area that we'd be a little bit more cautious with clients.
You mentioned the word insurance, you know, insuring clients' portfolios. How do you insure against the risks that we're seeing in the market today?
Well, it's about, again, having a properly balanced portfolio. So, yes, we understand there are potential risks that you can identify relatively easily. We know, of course, the biggest determining factor of financial market performance during the course of this year will be the ability of European politicians to solve the sovereign debt crisis. If that was to blow up, then clearly that would be an issue for financial market performance. Cash would be there. In fact, the standout performer would probably be government bonds. So despite the fact we don't like that as a single asset class, we still believe that's an important part of a portfolio. But I don't think we should actually be too negative either, because there could also be risk or opportunities to the upside as well.
Where
the
are
global
those,
economy
Henk?
continues to recover.
Where are those opportunities?
The global economy.
Where are your opportunities? Where's your equity portion invested in what areas?
The biggest opportunity that we see at the moment is the United States. We believe from a growth perspective, from an earnings valuation, so from an earnings momentum perspective and from a valuation perspective, that offers the greatest opportunity. It was our biggest overweight last year, and we were certainly rewarded for that position. In saying that, we have become a little bit more optimistic about the prospects for emerging markets as well, given the significant underperformance that we saw from emerging markets last year. Valuations we believe look far more appealing at the moment, and within emerging markets, specifically China, I think looks exciting.
Henk, you also spent some time on South Africa and analysing South Africa from London. What are your thoughts?
Well, I think the outlook looks a little bit more positive. There's no doubt about that. We had a very weak second half in South Africa. We'd expect growth to bounce back probably more than 3.5% in the first and second quarters of this year. So I think there's some good news on the back of that. Inflation likely to remain elevated around the 6.5% level, and we'd only expect a rise in interest rates to come through in the fourth quarter. So certainly some big opportunities from a South African perspective in terms of the growth being maintained. But from an investment perspective, we believe in the long-term outlook for commodities, and that's obviously a key driver in terms of that. We still remain relatively cautious, or at least not optimistic about gold, so that's probably one area to consider. In terms of the South African rand, just to throw that into the equation, which is obviously important from a global investment strategy perspective, probably a game of two halves, if anything. Expect it to remain relatively weak in the first half of the year as we continue to see that risk-off trade coming through, little investor risk appetite out there for emerging markets. But in the second half, as we expect conditions to start to improve, investors will be prepared to take more risk, and I think emerging market currencies will be an interesting play there. And specifically, they'll be looking at the high-yielding currencies, and South African rand certainly fits into that position. So it could be a very interesting year from a South African perspective.
Henk, just to go back to your emerging market exposure, are you buying direct into emerging market? In other words, are you buying Chinese stock or Indian stock, or are you buying companies that are doing business with emerging markets? In other words, getting a growing income stream? And that's the first question. The second one is, in America, where's your exposure there? Are you in any specific area, or are you just buying the broader index?
To start off with your first question, in terms of China, well, I think there's two ways to play that, and you've identified that quite clearly. In general terms, we're excited about China and believe there's ways to do that through different managers. But the other way to do that is something that we've called an Asian fusion portfolio. So what we've done is looked at developed market equities where you get the cheap valuation, where you get the transparency that you want, that have significant exposure to those fast-growing markets. So some of the stocks that we like there, for example, include LVMH, the luxury goods group, and we also like BMW, for example. And there's plenty of opportunities to pick those out. Caterpillar, perhaps another good stock that you can put into that particular category. In terms of the United States, well, in general terms, we like the overall market. We like large cap companies. We know that their balance sheets are very healthy. Many of them are awash with cash at the moment. If you're looking for evidence of that, look at the number of share buyback schemes that are being announced. Look at the increases in dividends that have been coming through. From a sector perspective, we particularly like technology, but we also like the oil majors as well. We've got some relatively robust, stable forecasts about where oil prices are going over the course of the next few years, up to, I think, around about $135 a barrel as you look to 2015.
Well, there you go.
And therefore, we see companies taking advantage of that.
If your call on the oil price is $135 a barrel, are you firmly in Sasol?
Sorry, I couldn't hear that
Sasol,
question.
the South African stock, considering you analyze the South African investment scenario, would you say
I haven't got a view specifically on that. I haven't got a view specifically on that stock. I'm sure we can come back to you in relation to that. But the big oil majors, those are out there finding new reserves, particularly from the United States, look incredibly attractive at the moment.